Welcome back, ladies and gents, to another educational video. I believe in the last one, we went over the first 2 pages of market sectors. Just gonna kind of refresh. So why do leading stocks within leading sectors matter? Basically, strong stocks move higher, trending stocks, and the ones with strength are the ones that are gonna be moving higher when market conditions are poor. So that means even though market is down, specific stocks, industries might be down, the strongest ones will be up, and those are the ones that we're gonna wanna trade. So continuing with these PDFs, third page is going to go into identifying leading sectors. So identifying leading market sectors is going to be a key skill component for us in swing trading, especially when looking to make more concise decisions in the market. Sectors or broad groups of companies tend to perform differently depending on the various external factors, such as the such as the economy, market trends, and even technological developments. By understanding how to spot which sectors are leading, you can make better trade choices and potentially outperform the market. Again, by a lot. Our whole goal is to outperform the S&P. It's not too hard to do that if you know what you're doing and you know what stocks to trade. But yeah, this guide will go deep into how you can identify leading sectors using several approaches, including analyzing sector performance, tracking economic indicators, understanding earnings reports, following news and trends, and using technical analysis. Even if you are a beginner, you're a complete noob, you don't know how to trade, you have no idea what you're doing, this explanation will basically help you understand each method and exactly how I use it when conducting market research for swing trading, aka scanning for the stocks that I want to trade, knowing what, just kind of building my trade plan, I guess. But yeah. Number one, sector performance relative to broad market indices. One of the first ways to identify leading sectors is by tracking how they perform relative to the broader market slash indices. The S&P 500 is one of the most common indices used to measure the overall market performance by comparing how individual sectors perform relative to the S&P 500 or other indexes, SPY, QQQ, CompuX. Again, whatever. You can quickly spot which sectors are outperforming and growing faster and which are lagging behind or bleeding. So again, if you guys want, I don't know if I'll leave my specific sector watch list in the link below. Personally, I use the BlackRock iShares. I basically have sorted by the 20-day percent gain change and the 50-day percent gain change. And I can see which sectors are up the most in the past 20 days and 50 days. And then I also have SPY in there to see which sectors are outperforming the S&P right now, which are underperforming, and just kind of compare and contrast and see what's basically leading. So it makes it really easy to do that. But yeah, if you guys want to build your own, I'll tell you how to do it. It's really simple if you're on Thinkorswim. But yeah, iShares, BlackRock iShares sector ETFs is what I use essentially. But yeah, cool. So open up your charts on the daily or weekly time frame. On one chart, have SPY open and then split the screen in two. Whatever kind of charting platform you use. If you guys are my students, you guys already know we're using Thinkorswim, powered by Schwab. But yeah, just have your screen split up and you can just both open one of the sectors and then you can have SPY on the other one. And then from here, you can gauge the top performing sectors in either hot or poor market conditions. So in the watch list itself, if you have SPY placed in there, you can just see like literally on the actual watch list what's like outperforming SPY and what's underperforming, but you can also just look at the technicals as well. So if you want to look at, the price action with SPY compared to, any other sector, you can definitely get a better feel for that and maybe more of a visual. So that's definitely an option as well, besides just staring at the watch list. Sector ETFs and indexes, sector exchange traded funds. I've heard nobody ever say it like that. ETFs are a simple way to track entire sectors. For example, the technology sector, Spider, you can use these, whatever. You guys get the point. Tech, healthcare, you guys can use those sector ETFs. Personally, again, BlackRock iShares focuses on the healthcare sector. By looking at these ETFs perform over time, you can tell which sectors are doing well. Again, personally, I use these sector ETFs from BlackRock iShares. Love them. Very simple. And it's like the first ones I found when I actually built my watch list, or built that sector watch list like 2 years ago. Haven't changed it. But yeah, if the price of an ETF is increasing faster than the S&P 500, that sector is likely outperforming the market. On the other hand, if the sector ETF is lagging behind, it may not be the best time to trade stocks within that sector. So again, go through your watch list, look at the technicals and see what's leading, but then also look at catalysts. What catalysts are pushing, a certain stock within an industry, within a sector. See what the root cause of the reason why that sector is pushing higher and kind of just get into the nitty gritty. Again, take it with a grain of salt. You don't need to find out every single working part. Just get a general idea of what's leading, what's rotating, what's good to trade right now, essentially. Sector rotation. We often rotate our capital and positions between sectors depending on the economic cycle. For example, tech and consumer discretionary sectors tend to perform well during periods of economic growth. However, during times of economic decline or recession, sectors like utilities and healthcare, which are considered defensive, tend to outperform. Understanding the sector rotation pattern can help you to predict which sectors are likely to perform well based on the current stage of the economy. We always want to evaluate current economic conditions, market conditions, and sector strength based upon that to have the best feel for what's currently the strongest and moving higher. So again, take it with a grain of salt. Just because market is moving higher doesn't mean every single time tech and consumer discretionary are going to be the highest, but it does, it does tend to kind of follow that. That's the overall trend, you could say, such as utilities and healthcare are going to be more defensive. And when market is poor, those are going to come more into play. But yeah, pretty self-explanatory there. When people have more money, when market's hot, people will spend on tech and stuff like that to kind of, I don't even know. When people have more money, inflation rates are lower. People will have more money to spend to further their business and stuff like that. It's just, they have more money to spend on things they don't necessarily need. They're willing to take more risk. Whereas when market's poor, they're going to go more into, just consumer staples, stuff they need. They're going to go like down to the bare basics. They're not going to be super loose about their money. They're going to be pretty frugal. So again, just kind of understand like even human psychology and where they're going to put their money during market periods that are, hot and moving higher or cold and just kind of pulling back. And then let's see, how far do I want to go? We'll do one more. So economic indicators and their impact on sectors. So economic indicators such as GDP growth, interest rates, inflation, and employment data have a direct effect on which sectors perform well. These indicators can provide important signals about the overall economy and help you understand which sectors are likely to benefit. Gross domestic product, GDP. GDP, if you went to high school and actually graduated, don't know how I did, but if you went to high school, you would have learned this in economy class, whatever, etc. GDP measures the overall health of an economy. A growing GDP usually means that businesses are doing well and consumers are spending money. So just like before, where I really botched up this explanation, going off the top of my head, this is what I was talking about. So during periods of high GDP growth, sectors like technology, consumer discretionary, and industrials often perform well because people are spending money on new gadgets, services, infrastructure. They're being stupid, or maybe they're taking calculated risks. They're more loose with their money. They're willing to take risks and just buy things that they want, not necessarily what they need. On the other hand, when GDP growth is weak or negative, sectors that offer stable income, such as utilities, consumer staples, again, the stuff you need, toilet paper, toothpaste, body wash, unless you smell, might perform better because people need essentials, electricity, water, and food, regardless of the economy. No matter what happens, you're still going to need your essentials. You can't live without those things. You can 100% live without tech and gadgets. You don't need gadgets or services to live. You don't need Netflix to live, essentially. Interest rates. Interest rates are a key driver of sector performance. When the central bank lowers interest rates, borrowing money becomes cheaper. Again, I tried to explain this off the top of my head, botched it. This is why I wrote it down, because it's a lot easier to basically explain to you guys. But yeah, again, interest rates are a key driver of sector performance. When the central bank lowers interest rates, borrowing money becomes cheaper. This benefits sectors like real estate, technology, and consumer discretionary because people and businesses are more likely to borrow and spend. Again, when they have more money, more cash flow coming in, they're willing to reinvest that and be a little bit more, calculated risk with their money. Again, conversely, when interest rates rise, it can hurt sectors that rely on borrowing money to fund growth, such as real estate, consumer discretionary, higher interest rates. However, it can benefit financials such as banks because they can earn more money on interest rates from lending at a higher interest rates. They make more money. They take it out of your pocket. And I think that pretty much sums up all I want to go through. I went over, about 3 pages. Most likely, I will continue this in the next video. If you guys enjoyed it, feel free to leave a like, comment, subscribe. Yeah, maybe this doesn't make sense. Let me know if you guys want me to kind of visualize this on the charts in the next video or something like that. But yeah, next video should come out in the next few days, and we will finish why leading stocks within leading sectors matter. But yeah, again, like, subscribe, follow my Instagram. If you guys want to be a part of my one-on-one coaching, feel free to, sign up in the link in the description or something like that. But yeah, you guys have a good rest of your day, and peace.